Hey, good day, everyone. My name is Bert Salazar, and I am the host for the Bert Salazar Retirement Show, which is actually the only retirement show that is now available on Facebook Live. I did some research last week, and there's nobody else doing what I'm doing, so I'm excited to be here with all of you. I'm hoping that all of you are taking very good care of yourselves and that you're keeping that social distancing, not only from each other, but also from the refrigerator. So make sure you pay attention to that. Today is going to be a great show because I've been getting quite a few calls, and whenever do we engage a client for the first time, we obviously do an audit on everything that they have done in the past. And one of the areas that we pay a lot of attention to is the tax deferred bucket, which is the bucket that contains a vast majority of the assets that our clients have from a retirement standpoint. And the tax deferred bucket, as many of you know, is your 401ks, your IRAs, your 403bs, your SEPs. If you're a self-employed individual, could be a simple IRA, could be a TSP if you're a public employee, or it could be DROP, which is a deferred retirement option program that is available for public employees. And then obviously I start asking questions as to their contribution limits, how much money they're putting in, what kind of rate of return they're getting on an annual basis, how is their asset allocation, how many times they visit with their advisors, why are they funding those retirement accounts to the level that they're doing so. And you'd be surprised the kind of questions that the kind of answers I actually get to many of my questions. So today I jotted down a bunch of notes that I want to discuss with each and every one of you. But I decided to call this Facebook Live show, which we're trying to get through Facebook Live. I'll upload it later on, but the system at Facebook was not allowing me to get through, so perhaps they're very busy today. But I'll upload it later on. But I'm definitely recording this because I want to make certain you get the best of it. So I want to go ahead and I want to tell you a little bit what we're going to be discussing today. We're going to be discussing 4 sections that I think are going to be very critical for you. And the name of this this retirement show today is going to be while you're playing checkers with your retirement accounts, the IRS is playing chess. So let me repeat that. While most of us, all of you, are playing checkers with your retirement accounts, the IRS is playing chess, and I'm going to tell you the reasons why that is the case and what you need to do in order to make certain it doesn't happen to you in the future. So section 1 is going to be the game of checkers in retirement, and this is the one that most of you are playing today. Section 2 is going to be dealing with the issues and things that you need to consider at retirement, issues and considerations. Section 3 would be the IRS game of chess in retirement. So now I'm going to flip it, and I'm going to be talking about the IRS. And then last but not least, section 4, I am going to discuss some of the strategic options that all of you are going to have available and that have available now that you need to make certain that you can pay attention to in order to enhance your retirement planning. Because at the end of the day, my goal for each and every one of you is to reduce the tax liability on your retirement plans as much as you possibly can, and moreover, to make certain that you can create a guaranteed income stream that neither you nor your surviving spouse would ever be able to outlive. So with that being said, let's get going, get excited. Please, I would like for you to jot down some notes if you have any. So I'm going to start right now. So the first one is that let's talk a little bit about why most of you are playing checkers with your retirement account. Well, first of all, you're making contributions to your retirement accounts on an ongoing basis, and the contributions are on a pre-tax basis. So as you know, the money you put in is pre-tax, and money grows tax deferred, and then when you pull it out, you have to pay taxes on the whole thing. So that's an exciting access to that type of an account. So that's why I can see that many of you and most of you are trying to max out or maximize all the contributions to those accounts. You're also enjoying a tax deduction every single year. So every contribution that you make is pre-tax, and then the year-by-year growth of those assets is also on a pre-tax basis. So that's a win-win. You're enjoying the tax deduction every year. So every time that you put money, so if you put in $10,000 into your 401k this year, you can actually deduct that from your total income. So you're getting that tax deduction, and that could be a win-win or that could be a bad thing. So we'll talk a little bit about that in a little bit. You're also enjoying, which is very important, the compounding effect of those assets on a year-by-year basis, which is important. And then we'll discuss some of the features and benefits and the things that you need to do in order to curtail some of the problems that come from the compounding effect that we'll talk about in the next few minutes. You're hoping, and this is a big hope, you're hoping to be in a lower tax bracket when you retire. And my experience has been that the only way you're going to be in a lower tax bracket is if you have been a financial failure for your entire life, and I'll explain that to you as well. And then at the end of the day, you want to retire at age 65. Now, I know some of you may be 60, some of you may be 70, some of you may be never, but for the sake of discussion today, most of you want to retire at age 65 and live happily ever after. So from that perspective, when you look at all the contributions and all the benefits that that retirement account is producing for you, you think you're on top of the world. You think that you have nothing to worry about. And the fact that the government was able to put this in front of you, that's a win-win for you, yourself, and your family. But from an economic standpoint and from an economic perspective and tax perspective, you're actually playing checkers with your retirement assets. And now, like Paul Harvey used to say, now the rest of the story. So whenever we have a client that comes in for the first time and we're doing a review of their taxable bucket, the tax-deferred bucket, and the tax-free bucket, we start to ask questions that probably no other advisor has ever asked these clients, because otherwise it would have made them think, and perhaps they would have started to do something a little bit different. Now, you don't want to throw away the baby with the bathwater. So what I'm telling you doesn't mean that you shouldn't be making contributions to these retirement accounts. What I'm saying is that you have to be very tactical about it. And there's an optimum amount that you need to put in these retirement accounts in order to benefit from the things I'm about to tell you. So what are the issues to consider of retirement from a business standpoint? Well, number one is, where do you think taxes are going to be in the future? Do you think that they're going to be at the same level that they are today? Do you think they're going to be higher than what they are today? Or do you think they're going to be lower? Now, depending on any type of venue that I use as far as giving webinars and seminars and, my videos that I put out on an ongoing basis, my podcast channel that has, north of 100 podcasts that we do every single week on that channel. Most of the feedback, big feedback that I get from the vast majority of not only my clients, but also my online community, is that taxes are going to have to be a lot higher in the future than they are today. And I actually do agree with that. Because if you take a look at where we are at today from a country standpoint and from a debt perspective, our national debt is exceeding 23 trillion. And we're not talking about everything that's going on with the COVID-19 virus and the fact that the government is giving out all this money that eventually they're going to want to recover some of it or most of it. So taxes are going to have to go up from that perspective. But I'd like for you to pay attention to the unfunded liabilities. And the definition of an unfunded liability for the United States are those liabilities that the U.S. government has promised to all of us that they don't have the money to be able to keep. So when you look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt, it actually exceeds $126 trillion and counting every single day. So taxes are going to be a major factor in your retirement planning. And also be very careful, because you have to bear in mind that the new tax law that was signed into law by President Trump in late 2017 that took effect January 1 of 2018, which is called the Tax Cuts and Jobs Act law, will actually sunset, will terminate December 31st of 2025. So we only have a 6-year window in which to maximize tax planning, because when we all wake up, hopefully January 1 of 2026, taxes are going to be a lot higher at that point in time than they are today. And that's because it is going back to the old law. But who knows who's going to be in power at that time, and what are they going to do to that old law, and what are they going to do from a taxable standpoint? So there's no doubt in my mind that taxes are going to be a lot higher in the future. So that may be a problem. That will be a problem for your retirement accounts. The other question is that I ask is, do you prefer compound interest or simple interest? Now, most of you are going to say, come on, Bert, that's a stupid question. Of course I want compound interest, but I'm asking that question for a reason, because 100% of the people that I ask that question to, they'll raise their hands and they'll say, yes, absolutely, I want compound interest as opposed to simple interest. But when I ask the next question of, do you want compound tax or simple tax, everybody goes, no, time out, I want simple tax. Well, in a perfect world, you would want no tax. And that's a world that I want to get each and every one of you to. But more than likely, most of you are not going to get there, because you're not going to do the work that is necessary in order to get to a tax-free world. But from an accounting standpoint, if you say, Bert, I want a compound interest, but I want simple tax, there's a way that you can do it in your retirement accounts. But once again, most of you will not, because you don't understand how the accounting process works. Because the challenge with the retirement accounts is that, yes, your interest and your gains compound on an annual basis, but so does your tax liability. So those are things that you don't want to go hand in hand, because otherwise, you're jeopardizing the future growth of those accounts and the income that you're going to generate out of those accounts. Another question that I ask often is, what percentage of your retirement income would you like to have taxed? Now, I'm not talking about the growth of the retirement account. I'm talking about that income that you want to generate on an annual basis once you pull the trigger on retirement. And when I ask the question is, what percentage of that income would you like to have taxed? The answer is always the same, Bert, 0. I want no taxes in my retirement income. Again, that's a wonderful idea, and it can be done. For most of you, the challenge is that, what you guys want done versus what you're doing are two different worlds. And the way that you're managing your finances in retirement, the probability that 100% of your income is going to be tax-free is going to be slim to none, unless, once again, you do proper tax planning. So again, I'm giving you some feedback, because remember, you're all playing checkers with your retirement accounts, and I'm trying to help you play chess. And the IRS knows this very well. Now, what is another question that I have is, what percentage of your Social Security benefits would you like to have taxed? Now, this is a big question, because the vast majority of my clients, when they first come to see me for the first time, they never thought that their Social Security benefits would be taxed. They said, Bert, they took this money from me for many, many years to give me a Social Security benefit, and they took it away from my payroll, so I paid taxes on that. So why do I have to pay taxes again? I don't have to pay any taxes on that money. Well, the sad thing about that is that most of you are going to have to pay taxes on that money, and a lot of taxes on that money. So if you do a horrible job in managing your Social Security distribution, up to 85% of your Social Security benefits are going to be taxable. You heard me right. Up to 85% of your Social Security benefits are going to be taxable. And then on top of that, if you do an okay job, perhaps up to 50% of your Social Security benefits will be taxable. But if you do the perfect job, 0% of your Social Security benefits will be taxable in retirement. And I'm going to share with you some of the ideas and some of the economic stratos that I use with my clients in order to get them to that level. Right. So the next section, and the next question there is, well, would you like to pay a higher premium on your Medicare premiums that you pay every year? And one of the challenges that most people don't realize is that anytime you have a very large tax deferred account or tax deferred bucket, like in a 401k, IRAs, and so forth, the mandatory distributions at a certain point may actually increase your income to such a level that even your Medicare premiums will be affected in a negative way. So the bottom line is that you have to be able to manage taxation, because when you get to retirement, it's all said and done. Now, if you don't do proper management, it's like jumping out of an airplane without a parachute, and it doesn't matter where you land, you're going to die, or it's going to hurt really badly because of the fact that you were not properly protected. So now I want to go into the next section, which is the section that is called the IRS game of chess in retirement. And this is how I want you to view it. I want you to make a paradigm shift and now put yourselves in the IRS shoes. And let's go through some of the ways that the IRS has put together these plans for each and every American that wants to participate in them. Now, number one, the IRS has all the time in the world. They have time on their side. You don't. Because you have, at some point in time, you have a mortality. Now, unless the U.S. disappears in the next 200 years, the IRS is going to be here forever anyway. So at least they're going to be living a lot longer than each and every one of us is going to live. Another issue from the IRS and how they look at this, these accounts is that, the consumers, all of us that are putting money into all of these accounts, we're assuming 100% of the financial risk. The IRS assumes 0% when it comes to the risk on these retirement accounts. The IRS controls the business relationship. They control the contribution limits, the access to those contributions. They also have limits that they're going to place on those accounts. They control your distribution requirements, age requirements, and tax assessment. So although 100% of the money that you have put in has been your contributions, the IRS controls everything in that account. So think of it this way. Let's say that you and I were to open a business together, and I come to you and you need money and you need my help, and you want to create a business partnership, because this is what you're doing. You have a business partnership with the IRS. So we're going to open a company, and basically I'm going to say to you, John, I'm going to go ahead, or Jane, I'm going to go ahead and lend you some money. We're going to open this company, and then you're going to make your investments, or you're going to start the business. Let's think of it from an analogy standpoint. And you don't need to pay me any interest rate. You don't have to pay me anything for the money that I'm giving you. But at some point in time in the future, perhaps down 25, 30, 35, maybe 40 years, for some of you, I'm going to come back to you and I'm going to say, hey, John or Jane, listen, remember all that money that I gave you, 30, 40 years ago. Now I want it back. And remember that when we entered into that deal, I didn't really tell you what the interest rate that you were going to have to pay me at that point in time, but now I will. And what I'm going to do is I'm going to decide now what interest rate would be the type of interest rate that would be suitable for me, not necessarily for you, but for me. And I'm going to charge that interest backwards to the very first time that you and I opened this business. Now, remember, we both own this corporation, let's call it an LLC, and you happen to be a minority shareholder, and I happen to be the managing member or the general partner or the senior partner, or I have the majority I'm the majority stockholder, so I have the ability to make all the decisions in the world, and you only have the ability to make very few decisions from an economic view. My question to all of you is, would you go into business with me at that point in time? Have you known everything that I have just told you? None of you would ever take any of my money, would ever take a check from me, would ever do anything with me as far as opening a business, because it wouldn't be fair to you. Well, the sad thing is that all of you are doing it every day when you're putting money into your qualified plans, because what the IRS has done is they created this corporation, which is the tax deferred bucket, and they allow each and every American to put money in there, and they become a minority shareholder while the IRS is the majority shareholder in this deal. So pay attention to that, because it's very important to some of the things that we're going to be discussing further. Now, what's another issue with the IRS? Remember how excited you were because you're playing checkers with your money, and you said, you're getting that tax deduction every year on your contributions? I have had accountants, although I'm an accountant myself and I do tax planning for my clients, that have said, my accountant told me, this client tells me that my accountant told me that the money that I'm putting into my 401k or my IRA, I'm getting a tax deduction, or I'm getting a tax break, or I get a tax savings. And the answer is, yeah, you're getting a tax deduction today, but you're going to have to pay for all of it in the future, because all the IRS did is they loan you that money that you should have paid to them at that time, and they're going to be collecting it at some point in time in the future. So, if you wanted to put $10,000 into your 401k, and you were in the 30% tax bracket, $3,000 of those dollars belong to the IRS, and $7,000 of those dollars belong to you. But because you placed those $10,000 into a tax deferred account, the IRS loaned you those $3,000. And as your gains compounded, so did the tax on the IRS side on those $3,000. And at some point in time in the future, they're going to be collecting all of that money. So that's something that you need to consider, because there is no tax benefit. There's a tax postponement of that tax liability. And bear in mind that when you postpone the taxes, you also postpone the tax liability, because the tax liability would be based on what tax bracket you're going to find yourself in, where taxes are going to be at some point in time in the future, which you have no control over, because you don't have the ability to make those tax decisions until you take full control of those financial decisions prior to making the contributions to those accounts. Something else that is important to talk about this is that for those of you that think you're going to be in a lower tax bracket in retirement, think again. See, even if taxes were not to go up, and by the way, we have an accounting firm, so we do accounting, we do business and personal accounting, we do payroll, we do bookkeeping, and I do tax planning, so we provide all those services for one of the companies that we own, and then retirement distribution planning for the other company. But think of it this way: even if taxes were not to go up in the future, there's a very high probability that most of your taxes are going to go up anyways. Why is that? Well, number one, while you're putting money away into these plans and you're employed before you get to retirement, you put those $10,000, so you take a tax deduction for that, so you don't report it for income in that year. If you have a mortgage, you're taking a mortgage interest deduction on what you're paying for that mortgage. If you have children, children not only are a deduction, but they're also an exemption, so you get a double benefit there. And some of you may be making contributions to your favorite charitable organization, and you're taking a deduction for that as well. What happens is when you get to retirement age, in this case, age 65, for many Americans, their mortgages are paid for. So you can no longer take a mortgage deduction. Now, you're no longer employed, you're no longer generating any type of W-2 or 1099 income, so therefore you can't make any contributions to a retirement account, so you can't take a deduction for that. Some of you may still have kids around in the house, but they're so old now that you can't take a deduction or an exemption on them. Actually, they may become a liability. That will be a liability to you. And then once you get to retirement age, all that money that you were making toward charitable contributions, you may still make some, but what happens in retirement from the vast majority of the clients that I engage is that they start to make a paradigm shift in which they start devoting more of their time to those charities than making dollar contributions. Now, last I heard, the IRS does not give you a tax deduction for your time when it comes to devoting time and energy to a charity. So even if taxes were not to go up in the future, global taxes, your personal income taxes will more than likely will, because then every dollar, unless you do proper tax planning, up to 85 cents of your Social Security benefits are going to be taxed. Any IRAs, 401ks, or any type of pension that you receive will be taxable. Any capital gains distribution or dividend distribution that you receive will be taxable as well. And then last but not least, and this is going to impact your Social Security benefits, any distribution that you take from your municipal bond funds will also be taxable as well, because it becomes part of the provisional income calculation to determine what percentage of your Social Security benefits will be taxed in retirement. So if you don't do proper tax planning, for me, when it comes to retirement, you have to make a paradigm shift. You're going from accumulation to distribution. So at the end of the day, it's all about cash flow. And the more cash flow that you get, the better. And the more guaranteed cash flow that you get, the better it even gets from a retirement and lifestyle standpoint. Another point that I'd like to make here is that, I don't know if most of you, and I would imagine most of you did, most of you watched many years ago a movie, probably is almost, 25, 30 years ago, Wall Street. Wall Street was one of the famous movies with Martin Sheen and Michael Douglas. And I love something that Michael Douglas said. His name in the movie was Gordon Gekko. Gordon Gekko. And he said, greed, for lack of a better word, is good. In your case, greed is very bad. Because one of the challenges that I have with many of the clients that I engage for the first time, they learn afterwards, is that most Americans are very greedy. So you're used to taking all those tax deductions and putting that money away. And then when we start talking about, well, how do we create a tax-free retirement plan? One of the key features of a tax-free retirement plan is for you to start doing Roth conversions. But when you get to that certain age where you're now eligible to make those Roth conversions, many of you are not going to want to do it. And you're not going to want to do it, not because it doesn't make financial sense, because it makes all the financial sense in the world, but because you're too greedy. Because in order for you to put money into a Roth, you have to be able to pay the tax today. So if you only have a 6-year window, and by the way, we're living in the third lowest tax bracket in the history of this world, at least of the United States, and you only have a 6-year window, wouldn't you rather pay the tax on some of those assets today and then have tax-free income for the rest of your life, regardless of where taxes go in the future? So now you can start to overfund the tax-free bucket, which is the most important bucket to have in your retirement system, if you call it so. But the IRS on the other side, because most of you have been thinking and playing checkers with your retirement assets, the IRS is playing chess. Because the IRS has allowed those assets to compound, and their taxes and their benefit to compound, and they can even compound it overnight just by increasing taxes at any point in time, and you have no control over that. And they know that most of you are greedy. They know that the vast majority of Americans are so greedy that they're going to allow that compounding effect to continue to grow until they have no choice to start taking the money out, once they hit either age 70 and a half or under the new rules 72, depending on, how old you were in 2019. I'm not going to go into a lot of details on that. But at the end of the day, the IRS is playing chess because they know that the vast majority of the time, they're going to win at any portion of this game from a business standpoint. So the other thing that is critical to understand, and this is why the IRS plays chess so nicely, is that the IRS, on the average, is going to collect 5 to 8 times more in taxes than the tax deduction. So that loan that they gave you over a 20, 25, 30, maybe even a 40-year period. How is that? Well, let me give you an example. Let's say that you were putting $10,000 into a 401k for 30 years. Okay. So that means that 10,000 times 30, that would be $300,000 of your contributions to that 401k. Now remember, the IRS loaned you $3,000 out of those $10,000 if you're in the 30% tax bracket. I'm just using round numbers. So that means over 30 years, that would be $90,000 in loans that the IRS gives you. So all of a sudden, you put in $300,000 and $90,000 belonged to the IRS. So $210,000 was actually your money, and the other $90,000 was a loan from the IRS. So let's say that over a 30-year period or a 40-year period, now the growth of that money is now $1 million. And you say to the IRS, and you say to your advisor, say, hey, I want to start getting $100,000. I'm just using a round number. I'm going to take $100,000 out of my accounts and report it to taxes. More than likely, you're either going to be in a higher tax bracket, and that's going to be more than likely. But let's say, for argument's sake, you're going to be in the same tax bracket, the same 30%. So you pull out $100,000, you're going to pay $30,000 to the IRS. I'm not factoring in your deductions, exemptions, and credits. I'm just using a roundabout number so you can get a feel for this exercise. So in the first year, you're going to pay the IRS $30,000. In the second year, you're going to pay them another $30,000 on that second $100,000 deduction. And on the third year, you're going to pay them another $30,000. So in a very short period of 3 years, the IRS has already recovered in taxes what they gave you as a loan over a 30 or a 40-year period, just in 3 years. The rest of the money has not been taxed. And every year, in the fourth year, when you pull out another $100,000, there goes 30 to the IRS. And the fifth year, there goes another 30. So when it's all said and done, the IRS ends up with a lot more money. Could be anywhere between 30, maybe even 50% of those dollars. So the ratio of rate of return from an IRS standpoint versus yours is enormous. The IRS is going to beat you at this game every day of the week. So the final question I have for you before I go into the last section is, well, whose pension plan or whose retirement plan have you actually been funding? Yours or the IRS? Ponder that for a minute, okay? Now let me walk you to section number 4. And these are some of the strategic options that all of you can have in the way that you program your retirement distribution planning. Number one, there's a way that you can actually beat the IRS at their own game, but you have to be able to play chess. There's no way you're going to beat the IRS by playing checkers, because they're going to beat you every single day of the week. Now, we're going through this COVID-19 virus, and you've seen what the stock market volatility has done. For many of you, your 401k has become a 201k or something a little bit higher than that. Many of you have lost, 30% of your money. As a matter of fact, for most of you, in a matter of, 6 weeks, you have lost all of the gains that you had in early 2020, all of the gains in 2019, 2018, and most of 2017. So in a matter of 6 weeks, almost 3.5 years or 3 years of gains have been totally wiped out from your retirement account. Here's something I got to tell you. And I don't know if you ever heard this, but this is something that I say in a lot of my seminars and videos and so forth. There's something in retirement called a retirement kill zone. And a kill zone are what is that kill zone from a retirement standpoint? And the kill zone is the 5 years preceding retirement. So if you're going to retire at 65, that would be between age 60 and age 65. And then the first 5 years post-retirement, going from 65 to 70. So that 10-year window between 60 and 70, if you have a retirement date of 65, is what I call the kill zone. because any financial mistake that you make in that 10-year period can bring destruction, havoc, and unhappiness for you and your family for the rest of your life. And that includes bad financial decisions, that includes stock market volatility, interest rate volatility. That can mean if you have any healthcare issues, all of those issues are going to have a major impact in your life. So those are things that you got to be very careful about, because we're living through one of them right now, which is the stock market volatility that is so critical to all of you. What are some of the strategic options? Another one is you want to limit your contributions to your tax deferred accounts, because if you limit the contributions to the tax deferred account, and maybe you can start shifting some of those 401k contributions to a Roth 401k, or to a Roth IRA, or to a 7702 plan, which is a cash value life insurance plan, so the plan that I use with my clients, where we actually reduce the death benefit significantly because we're using it primarily as a supplemental retirement plan, and all the money out of there is tax-free. Same as your Roth 401ks and your Roth IRAs. At least you're starting to balance the role of the IRS buckets when it comes to your individual finances. So now you're starting to get a much better balance between your taxable, your tax deferred, and your tax-free bucket. Remember, in your taxable and tax deferred bucket, you should only have the optimum required amount. And I know what those amounts are. If you don't know, feel free to call me and then I'll go through it with you. Everything else should go into your tax-free bucket from a business and retirement standpoint. Now, you also want to create and adhere to a tactical retirement blueprint. And what a tactical retirement blueprint does, and this is the one area that we specialize because we actually created the tactical retirement blueprint, it allows you to go from thinking from an accumulation standpoint to thinking about a distribution standpoint. What do I mean by that? Think of climbing a mountain where the summit of that mountain is going to be age 65 for most of you, which is your retirement age. So as you're climbing, you're working, you're putting money away, you're looking for the rate of return, highest possible rate of return, higher contribution, asset allocation, and so forth, and you get to the top of the mountain. When you start to come down on the other side of the mountain from a retirement standpoint, it's all about the distribution rate. So the accumulation rate doesn't mean that much anymore. Now, you don't want to lose money, but you want to make certain that your distribution rate will be there and that distribution rate will be guaranteed for the rest of your life, because you don't want to run out of money before you run out of life from that perspective as you're coming down the mountain. By the way, I call that the mountain analogy, and I use Mount Everest as my example all the time. And just so you'll know, 70% of the people that have died on Mount Everest did not die on the way up. They actually died on the way down. Most of the retirees, most of the type of planning that I do, once I do a complete audit, most of the clients that I engage for the first time actually die on the way down, because they're going to run out of money before they run out of life, and they're going to have to go to Walmart and pull and ask for an application so they can become a Walmart greeter in their mid-80s, as most of us see when we go to Walmart. So that's something that a tactical retirement blueprint will allow you to avoid if you do it the right way. You also want to create and or eliminate your taxes in retirement. And there are straddles that we use, and there are areas that we use from a tactical standpoint that will allow you to start moving more and more of your assets to a tax-free bucket. So it doesn't matter where taxes go in the future, you're going to be totally protected. And therefore, you would be jumping out of this taxable airplane with the best possible parachute so you can have a safe landing regardless of how long you're going to live in your life. A tactical retirement blueprint will also help you reduce and or eliminate your Social Security taxes in retirement. And we do that by doing provisional income calculations every year to make certain that, you know, the distributions out of all these retirement accounts are not going to have a negative impact on your retirement distribution planning and the taxation of those assets. By the same token, if you do it properly, then you're not going to have to worry about paying additional premiums on your Medicare taxes in retirement, which is so critical for most Americans, because at that point in time, you don't want to pay any more premium than you have to in order to receive that benefit. For those of you that don't know this, when you get to age 65, you got to take Medicare, whether you want or not. And by the way, when you apply for Medicare, there's a 7-month window that you need to abide by. Otherwise, you're going to have to pay penalties for the rest of your life. And the 7-month window starts with the month of your birthday, and then 3 months before, 3 months preceding, and then 3 months past your birthday. So you have a 7-month window that you need to apply for those Social Security benefits in retirement. And then obviously, if you do proper tax planning, and this is very important, if you're able to create guaranteed cash flow, if you're able to reduce your taxes significantly, let's say that you're not able to go from, you know, a tax liability of 30% to maybe I can get you a tax liability of 10%. Well, at 20 percentage points, or maybe 100%, I'm able to deduct all of it if I have enough time. If I have anywhere between 5 and 10 years on my side of the ledger, I can do wonders. If I have less than 5 years, I can do some really good things, but are not going to be as efficient as if I have more time. And then once you're in retirement, then I can start shuffle the cards a little bit. But once you're in retirement, it's very challenging, other than being able to create guaranteed cash flow. And that's something very important that all of you should pay attention to, because at the end of the day, retirement distribution and retirement income is about guaranteed cash flow. And you're going to need specific products like annuities. You cannot have a successful retirement plan, I would say for 99% of you, unless you have guaranteed annuities providing you with guaranteed income. And by the way, annuity is any type of income that is guaranteed for you. So if you have a pension from a public system that you work for, or from a private corporation and you're receiving a pension for life, that's an annuity. If you're receiving Social Security benefits, that's an annuity. But you could also have the ability with your retirement assets be able to create guaranteed annuities and guaranteed income that you cannot outlive. And they can keep up with inflation. There's so many flavors of those. It's just like going to Baskin Robbins for ice cream. There are 31 different flavors. So there's a lot of stuff that you can do along those lines. Listen, there's a lot of stuff that you need to do. Retirement is not as easy as you thought it would be. So I do recommend some things. If you want to have a conversation with me, you want to schedule a call, I'll give you 30 minutes so you can pick my brain, no cost or obligation. And we can discuss to see if any of these features and benefits, or if a tactical retirement blueprint may be suitable for you, or an audit of your financial assets may be suitable as well. Feel free to call me. You can reach me at area code 786-766-1042. You can also send me an email. I'll make it simple for you. Send it to Bert, B-E-R-T, at BertSalazar.com. That would be B-E-R-T at BertSalazar.com. BertSalazar.com. Once again, always remember, and I thank you for always being such a loyal online community member and client. Always remember that my goal for each and every one of you is to help you change the way that you see things, because when you start changing the way that you see things, you'll be surprised the things that you see change. So have a great day, and I'll talk to you soon. Take care. Bye-bye.